All right, so you've probably seen the headlines. Inflation is finally starting to ease up. And that should be great news, right? Especially if you're thinking about buying a house. But there's this one really frustrating question that pops up, and that's exactly what we're going to unpack today. It's a real head scratcher, isn't it? The good economic news is rolling in, but when you look at what your mortgage payment might be, it just isn't budging. It feels like it makes absolutely no sense. But don't worry, we're going to play detective today. Piece together all the clues and solve this thing. Okay, so every good mystery starts by laying out the facts of the case. So let's do that. On one side, you've got these positive signs in the economy, but on the other, well, there's the frustrating reality for anyone trying to buy a home. So here is the core of the problem. A really key inflation measure. It's called the PCE, and it's the one the Fed watches like a hawk. It actually went down in September. Now, common sense says, great, lower inflation should mean lower mortgage rates. But the reality, mortgage rates actually ticked up a little bit. It's an economic head scratcher for sure. So what gives? All right, let's look at our first clue. And for that, we have to turn to the Federal Reserve. You know, everyone hangs on their every word, trying to guess what they'll do with interest rates. And right now, the market is convinced it knows what's coming next. Get a load of this number, 87%. That's not a small number. That is the probability investors were giving to the Fed cutting interest rates on December 10th. I mean, that's practically a sure thing in their minds. A massive, overwhelming expectation. And, this isn't just some poll or a bunch of people guessing. This number comes from something called the CME Fed Watch tool. It basically tracks where investors are putting their real money in the futures market. So it's a super powerful signal of what the market truly believes is going to happen. But here's the plot twist. Just before the market got this certain, the Fed chair himself, Jerome Powell, basically said, hey, hold your horses. A December rate cut is not a given. And that right there, that's a huge clue. There's a big gap between what the market is betting on and what the Fed is actually saying. And that gap, it's a critical piece of this puzzle. Okay, this brings us to clue number 2. And honestly, this is the real secret sauce. We hear about the Fed all the time, right? They're always in the headlines. But here's the thing, they don't actually set the mortgage rate you see online. Nope. That power, it belongs to someone else. Investors. So, if you want to understand mortgage rates, you have to get to know one thing, the 10-year Treasury yield. Think of it like a barometer for all kinds of loans. It's the interest rate the government pays on its debt, so it's considered super, super safe. Lenders then look at that super safe rate and say, okay, a mortgage is a bit riskier, so we'll charge that rate plus a little extra. The takeaway? Wherever the 10-year Treasury goes, mortgage rates are sure to follow. And boom, here we are, right back at the center of our mystery. That good news about inflation comes out, you'd think that 10-year Treasury yield would drop, right? But it didn't. It actually went up, just a bit, but still. And because mortgage rates are basically attached at the hip, they went up too. So the big question is, why on earth would investors demand more money right after hearing good news? Well, the answer comes down to this really crucial idea called pricing in. See, the market is always trying to guess the future. It's like if you peeked and already know you're getting a new bike for your birthday, you're not going to be shocked when you open the box, right? For these investors, the good inflation report wasn't news. It wasn't a surprise. They had already bet on it happening, so when it did, it was just confirmation. No big celebration, no big drop in rates. Okay, let's get a little more specific with another key term you should know, the 30-10 spread. It sounds complicated, but it's not. It's just the gap between a 30-year mortgage rate and that 10-year Treasury yield we've been talking about. Basically, this gap is the risk premium. It's how much extra investors are demanding to lend you money for a house instead of just giving it to the super safe government. Now, this is actually where we find a little bit of good news. See, before the pandemic, that spread, that risk fee, was usually less than 2 percentage points. But during all the craziness of 2022 and 2023, it got huge, sometimes up to 3 points. Investors were just plain nervous. The good news is we're finally seeing that spread start to shrink back down toward normal. And that matters to you because it means that even if the main Treasury rate doesn't move, your mortgage could still get cheaper as that risk premium goes away. Okay, so we've got the Fed, we've got what investors are thinking, but there's a third clue we need to look at. A real wild card that's messing things up for everybody. Tariffs. $1,700. That's roughly how much tariffs are costing the average American family every single year. Tariffs are just taxes on stuff we buy from other countries, and that cost gets passed right on to us at the checkout counter. This makes inflation feel really sticky, like it just won't go away. And for investors thinking 30 years down the road, that makes them really, really nervous. And you can see the impact crystal clear right here. So the official core inflation number for September was 2.8%. But if you strip out the estimated effect of those tariffs, well, economists figure the number would have been more like 2.4%. That means tariffs are literally propping inflation up, keeping it higher than it should be. And this isn't just a temporary little blip either. Analysts think this pressure from tariffs is going to stick around. Now, if you're an investor who's about to lend someone money for 30 years, that's a huge deal. It's one more reason for them to charge a higher interest rate today just to protect their money from that inflation tomorrow. All right, we've got all our clues on the table: the Fed, the investors, and this tariff wildcard. So let's bring it all together and figure out what happens next. So here's the bottom line. Think of mortgage rates as a big tug of war. On one side, you have the Fed, which kind of sets the general direction. But the real muscle, the ones really pulling the rope, are the investors. And their decisions are shaped by long-term fears about things like inflation and tariffs. And all of this is playing out while other economic pressures, like a weaker job market, are making things tough for everybody. And if you think the Fed just pulls a lever and mortgage rates obey, let me tell you a quick story from late 2024. The Fed cut its main rate by a full percentage point. That's a huge move. And what did mortgage rates do? They went up by the same amount. Why? Because inflation suddenly spiked, investors freaked out, and their fear completely overpowered the Fed's move. It's the perfect example of the market having the final say. Which, of course, brings us to the million-dollar question. With all these different things pulling in opposite directions, what on earth are mortgage rates going to do in 2026? Well, if you're looking for a simple answer, you're not going to get one. Even the experts can't agree. In one corner, you've got Fannie Mae, who's pretty optimistic. They think rates could actually fall below 6% by the end of the year. But in the other corner, you have the Mortgage Bankers Association. They're a bit more cautious, thinking rates will hang out around 6.4% on average. The fact that they're so divided tells you everything you need to know about how uncertain things are. So where does that leave us? We have a much clearer picture now, right? The next time you see a news story about what the Fed is doing, you'll know that's only part of the story. You'll remember it's really about the investors and that all-important treasury yield, and even weird wildcards like tariffs. It all boils down to one final big question. When it comes to your mortgage, who's really in charge? The folks in government or the massive collective sentiment of the global market? It's something to think about.